Hello and welcome to our discussion on the accounting of assets. Under that, we are going to discuss today on the inventory accounting. And inventory accounting in India is as per the Ind AS 2. So in this session, we'll focus on the Ind AS 2, which relates to the inventory accounting. At present, we are not going to compare the accounting standard 2, the older version, with Ind AS 2. Neither we are making an effort to understand the difference between Ind AS 2 and IFRS. Here the focus is only on Ind AS 2. Though in principle, most of these provisions or the clauses of these standards are more or less same. So inventory is an important item on the balance sheet and it affects the income statement as well as the cash flow statement and the balance sheet. So there is a need to understand what is inventory, and Ind AS 2 define the inventory as assets which are held for sale in the ordinary course of business, or assets which are used in the process of production for such sale, or in the form of material or supplies to be consumed in the production process or in rendering the service. So therefore, inventory deals with or captures those assets, the main business of that organization is dealing with those assets. For example, for a furniture shop, the furniture is an inventory. For a bookseller, inventory is a stock of books. For a textile dealer, the textile is the inventory. But for a computer dealer, computers are inventory. But the furniture for the computer dealer is not inventory. They come under fixed assets or property, plant and equipment. The important thing under accounting standard 2, Ind AS 2, is about measurement and the presentation. The measurement of inventories, there is a broad principle applicable all over the world, is that inventories shall be measured at the lower of the cost or the net realizable value. In other words, in accounting we conventionally follow the conservative convention. So inventory valuation meticulously follows that. The market value or the cost value, whichever is lower, is shown on the balance sheet. But we'll observe that in a minute, the impact of it. But what is this cost? The cost of inventory shall consist of all the cost of purchases, that means the purchase price, the cost of conversion, and all other costs incurred in bringing the inventories to the present location. So the cost of inventory consists of the purchase price, the cost of conversion, for example for a manufacturing companies, and all other costs required to bring the inventories to the present location. Let me elaborate that. The purchase price of inventory consists of the purchase price payable or paid to the supplier, import duties and other taxes. You have to be careful, import duties and other taxes, only those which are not recoverable in a later stage. In other words, if I pay VAT and if I'm going to recover that VAT, then that VAT will not be part of the cost. But if the VAT is not recoverable, then in that case we are going to include the VAT in the cost of the material. So therefore, the cost of the purchase consists of the purchase price and the duties and other taxes. It is act very clearly, the standard very clearly says, other than those subsequently recoverable by the entities from the taxing authorities. So if there is a recovery, then that tax will not be included. Any other expenses like transport, handling and other costs which are directly attributable to the acquisition of these goods, then that forms a part of the cost of purchase. However, trade discounts if any, rebates if any, or any other similar items which has the effect of reducing the cost are deducted while computing the cost of the purchase. The cost of conversion. The cost of conversion includes all those expenses directly related to the units of production, particularly the direct labor. They also include any overheads, fixed or variable overheads, particularly related to the production overheads, which are incurred in converting the material into finished goods or material into partly finished goods. So therefore, the cost of conversion is the labor plus the overheads which are incurred for production of the goods. And these overheads may be fixed or variable. Fixed, normally depreciation, maintenance of factory, the cost of factory management are considered to be fixed, whereas the variable overheads are indirect material and indirect labor. But this indirect and material and indirect labor to a large extent depends on the interpretation of the management. So cost, the cost of purchase plus cost of conversion and cost of conversion are two important components of the inventory cost. The other one is the other related cost. All other costs which are included in the cost of inventories are only included to the extent they are incurred for bringing the inventories to the present location. If I pay a transportation, carriage inward to bring the raw material to my godown, then in that case, that inventory cost, the carriage inward forms a part of the inventory cost. So there are three broad components of the inventory cost. One is a cost of purchase, other is a cost of conversion, and other costs. So that's a measurement of inventory. However, there is a process in which the cost is attributed or transferred to the balance sheet and income statement. So when the stock or inventory is purchased, it is an asset. But when it is sold, then it becomes an expense. So therefore, there is a need to understand how is this material shown as a cost in the income statement as a cost of goods sold, and the unsold stock as inventory on the balance sheet. And there are two popular methods for calculating the cost of goods sold and cost of inventory unsold, and one is called Fifo. The other one is a weighted average cost formula. Fifo is a first in, first out, and the other one is a weighted average. But it's important to note that an entity shall use the same cost formula for all inventories having similar nature and use to the entity. But if the use are different, then of course the company has the freedom to move from one method to the other. Let us take an example to understand the effect of the measurement of inventory. So let us take an question, some data, and see the effect of it. Suppose we have purchased. Suppose I give this information. Okay, the information is about the purchase. Let me remove this so that we can understand it better. Okay, so yes. Suppose you purchased goods, stock of goods on 1st April, 10th April and 15th April, and you sold goods 8,000 units on 20th April. But before we take the inventory into the books, let us see what is the present status. So the balance sheet shows the business has a capital of 800,000, started with 800,000, and so there is a cash of 800,000. So there is no other purchase or sale as of now. So therefore balance sheet asset is equal to sources, which is capital and cash. Let us now treat these purchases. So the purchase price is already given. Suppose there is no cost of conversion or other expenses. So the total purchases made during the period is equal to 304,000. So therefore, when I purchase the stock, there is a payment of cash, assuming there is a cash purchase. And on the balance sheet, we are going to have a cash, the stock of 304,000. Observe this, okay? 304,000. So we purchase stock for cash. Instead of treating individually, I combine them together and shown the purchases. But the important point, what will happen to this stock when part of the stock is sold? So therefore, sales is equal to 8,000 into 85, and let us assume that the sales is for cash. But what is the cost of the goods sold of this 8,000 stock? So you have you had purchased stock of 13,500. Now we have selling 8,000. So what will be the cost of goods sold? And this is where we fall back on accounting standard, which says you may use Fifo or you may use weighted average. Let us use Fifo, okay? So if I want to use Fifo, so we want to find the cost of this 8,000 units by using Fifo. So the first in first out method, says that assumes that in items of inventory that were purchased or produced first are sold first. So the items or inventory which are purchased first are sold first. So out of this 8,000, as for Fifo, so 3,000 will be sold first. So the cost of that is 20. So therefore, out of 8,000, 3,000 cost, the cost of 3,000 units is 60,000. And the cost of, but we have sold 8,000, so the balance 5,000. The balance 5,000 will come from the purchases of the 10th April. So therefore the purchase price will be 22. So therefore the cost of the balance 5,000 is, so 170,000 is the cost of goods sold by using the Fifo method. But if 170,000 is the cost of the goods sold, what is the unsold stock? The unsold stock is 13,500 minus 8,000, so 5,500. And what is the cost of it? Because we are using Fifo, so the one out of this 6,000, 5,000 have been sold, entire 3,000 have been sold. So therefore this 5,500 includes 1,000 at the cost of 22 and the 4,500 at the cost of 25, at the cost of 25 per unit. So therefore the cost of inventory, unsold stock, the cost of unsold stock is equal to 1000 into 1000 into 22 and 25 into 4500. So 134,000 is the unsold stock. Now let us recap. So by using Fifo, because we are using Fifo, the 8,000 units which are sold are valued by using the selling the goods which are purchased first. So therefore 8,000 from the earliest purchase, then the next or subsequent purchases. In the same way, unsold stock will be for the goods which the latest purchase will remain as the unsold stock. Now what's happened to the profit? Profit is equal to, gross profit rather, is equal to sales minus cost of goods sold. And since no information is given about other expenses, we transfer the entire profit to the balance sheet as a retained profit. And since no other inflows or outflows are there, the cash in hand is total receipts minus the total payment. So 1.175 million becomes the cash in hand. So the capital is 800,000. The profit is 510,000. Cash in hand is 1175, and stock of goods sold is 134. Stock of unsold is 134,000. So observe, keep a watch on this profit and the unsold stock, okay? Because the methods of inventory valuation will affect the profit and the stock. In other words, the methods of inventory valuation will affect the cost of goods sold and inventory, so profit. So the profit under Fifo is 510,000. Now let us observe the same thing with the inventory valuation as weighted average. Now observe this. Same information, okay? Purchases with the balance sheet of 8,000. We started business. So the cost of goods sold, okay? The cost of goods sold will be 8,000, and since it is 8,000, we are going to sell on the basis of weighted average. So if it is weighted average, we have to observe that the weighted average cost is equal to 25. So let us see what is weighted average. So the weighted average, the cost of each item is determined from the weighted average of the cost of the similar items at the beginning of the period and the cost of the similar item purchased during the period. Let me explain that here. So the cost of this 8,000 will be the weighted average of all the purchases made during this period. So P1 into Q1 plus P2 into Q2 plus P3 into Q3 divided by Q1, Q2, Q3. In other words, it is 304,000 divided by the total quantity, it is 23. So weighted average cost is a weighted average of all the purchases made during the period up to that, as long as that stock stays. So therefore, the weighted average, the cost of goods sold will be 8,000 into 23, and the cost of unsold stock is 124,000. So observe the cost of goods sold as is 184,444, whereas here the cost of goods sold is 170,000. So we can put it here. So COGS under Fifo and under weighted average. The cost of goods sold under Fifo is 170,000. The cost of goods sold under weighted average is 180,000. So the difference in the cost of goods sold is not because you purchased or sold more goods or less goods or a different price, but the method of evaluation or method of inventory valuation. So what is the cost of unsold stock when we use weighted average? The cost of unsold stock when we use the weighted average is 124,000. But when we use the FIFO, the cost of unsold stock is equal to 134,000. So the profit, gross profit, so gross profit under the FIFO is 510,000. The gross profit under the weighted average is 499. Okay, 1,556. So one can observe that inventory valuation will affect the method of calculating the value of the closing stock, the value of the cost of goods sold, so it will affect the profit. So therefore we have to remember that inventory valuation is one of the important tools in the hands of the management to manage the profit by managing the methods of inventory valuation, FIFO or weighted average. So that is why the accounting standard is very particular and says that this accounting standard is mandatory, the companies are bound to follow this standard and also disclose the method if any change happened and impact of the change on the profit and the assets. So inventory valuation therefore is one of the important accounting standard which has an influence on the income statement and the cash flow statement. Thank you very much.